profit. I&M Holdings has reported a decline of 6% in the gross profit for the year ended 31st December 2017. The year also saw gross non-performing loans and advances rise by 106% to 19.5 billion Kenyan shillings, which the bank attributes to the economic headwinds in Kenya and the unintended consequences of interest rate capping. Gauri Gupta, General Manager for Corporate Advisory at I&M Holdings, joins us now. Gauri, thank you very much for staying on the line as we speak on this. We're keen about two things. Number one, the exact impact on the interest rate capping and what happened with the political environment last year. We know this has had a hand in your numbers, but we don't know to what extent. Help us break this down.
Sure. Thank you, George. Pleasure to be with you this evening. So yes, that's right. I think there were a combination of factors which led to the both the decline in the profit as well as the surge in NPLs. We had the interest capping. We've seen this was the first year where the full effects have come through. So despite a good jump in the loan book, the net interest income has dropped. So that's one. We've Kenya, which is really the flagship subsidiary of Holdings, has been affected by some of the other factors. You know, the prolonged electioneering, adverse weather conditions, and also changes in the regulatory framework, which have affected some of our borrowers. At I&M, what we've done is taken a very prudent and rather aggressive position on NPLs. And wherever we've seen signs of stress in the book, we have opted to classify them as non-performing, and we've taken the provisions.
Right, Gauri, okay, another point, since you've mentioned the issue on the net interest income and the provisions that you have, we'll get into the loan loss provisions a little later, but the net interest income increased slightly to about 15.55, but the net profit dropped to 7.26 billion. This is well in line with the provisions that you're creating within the bank, but is there anything that we need to point out particularly?
See, the profit is a factor, is a function of several factors. So yes, if you see the operating income has shown a marginal increase or more or less the same level. But the profit is lower, one, because of provisions, which we've already talked about, and the other is an increase in the operating cost. So again, I think it's a reflection of I&M's long-term view. And we continue to invest in our infrastructure, in our people, and in the new strategy that we put in place since 2016. This 2017 results are also the first year when we see the walkthrough of the Gyro acquisition. So we took on board all the branches and all the staff. So the increase in operating cost also reflects the additional costs arising from the acquisition.
Right. In regards to the same, now your loan loss provisions, 4.1 billion from 2.9 billion. How much do we expect this to rise? Because A, we have IFRS 9, the interest rate cap, we should expect that to stabilize. But we also have your provisions and growth in loans growing very fast, not only for you, but also your subsidiaries. So how much further should we expect this number to go?
Not much. Actually, on IFRS, we have already kind of taken cognizance of this in our 2017 numbers. And in fact, if we go by the trends in the first quarter, we should see to recoup some of the provisions. As I said, many of them were as a matter of abundant caution and prudence. And on some of these accounts in the loan book, we are already starting to see signs of recoveries coming through in the first half of the year.
What are your prospects for customer deposit growth and increasing that? We're guessing this is not only in terms of anticipating direct deposit from the customer or the Social Security Fund. What are your aspects for growth there?
See, in 2016, we put through a new strategy, the IMARA strategy, and that one of the key pillars of this strategy is developing unique customer value propositions for customers in the premium, personal, and business banking segments. So as part of that strategy, we are looking to grow the deposit book as well, with some focused efforts now on each of these segments.
Right. Still moving on, even after all these numbers and a significant drop in your gross profits, directors have recommended a dividend of 3.5 Kenyan shillings per share. Talk to us about that.
Yeah, but I don't think it's a significant drop in profit. At the group level, we are looking at a 6% drop in profit after tax. But at the same time, the company or the group is well capitalized to deal with these year-on-year fluctuations, and the board did not think it necessary to really cut down on the dividend payout. So the dividend payout ratio has gone up marginally to 21% from just under 20% last year.
All right, final, before I let you leave, here in Rwanda, we asked them about the employee benefits. We asked Robin Bairstow. The employee benefits are barely 5% year on year here. What about Kenya? This could come as one of the factors that would possibly motivate your employees for the next year or so.
No, I think our employee benefits are quite competitive and in line with the industry. So I don't think we are lower than market, really, in any case.